I'm Gail Tucker, PwC's Global Accounting Lead on Insurance. I'm a member of the recently formed ISB's Resource Transition Resource Group on IFRS 17 and also a member of IFRAG's Insurance Accounting Working Group. I'm delighted to be joined today by Sandra Thompson, who's our Global Financial Instruments Leader in our accounting consulting services. So IFRS 17 came out in May and it's quite a complex standard. It's quite interesting that when we look at insurance contracts around the world, they look different in different parts of the world and they're certainly accounted for differently today. What this new standard does is make insurance contracts be accounted for consistently, which inevitably means there's a lot of change for everyone who issues insurance contracts. It will not only change the measurement of the liability, it's also going to change what the profit recognition is over the term of the contracts and what your income statement looks like. And I think it's quite interesting because as we get into more of these videos, you'll see that the measurement uses data that is not data that the insurers necessarily have used in the past. So the operational and system implications are huge around IFRS 17. So what we want to do in this series of videos is really just break that standard down into bite-sized chunks, reflect on different elements of the standard and hopefully help you as you implement IFRS 17, what are the things I need to think about. So on today's video, what we want to do is start at the beginning. We want to look at what contracts are in scope of this new standard and when they might need to be added together or separated out. So IFRS 17, when does it apply, is always the first question I get asked, which is it's for periods starting on or after the 1st of January 2021. Now, when I say that, the number of CEOs who say, I'll be retired, I know that. The reason it is 2021 is this is quite a complex standard and will take time to implement, which is why it's important that companies start looking at it now. Now, it applies to all insurance contracts that are issued. And the definition of insurance contract is the same as we have today under IFRS 4. It's where a contract where one company accepts significant insurance risk from another party, who's often called the policyholder, and agrees to compensate them if an adverse future uncertain event occurs. So it's the same definition we have today. It will apply to insurance contracts, reinsurance contracts, and investment contracts with discretionary participation features.
I think one thing to note is it doesn't apply to insurance contracts held with the exception of reinsurance, which Gail's just mentioned. So Gail, does that mean that non-insurers don't need to worry about IFRS 17?
I'm glad you asked that question. And the answer is no. So it applies to all insurance contracts, whoever they're written by, but there are some helpful exemptions in the standard. So initially we have the same exemptions we have under IFRS 4 today. So if it's a warranty issued by a manufacturer, dealer or retailer, they are not in the scope of IFRS 17. Similarly, the assets and liabilities in pension schemes and contingent consideration for business combination, all those are out of scope of this standard just as they are out of IFRS 4. But there's one additional change which I think is really important for non-insurers to be aware of. And that's what we call the fixed fee service contracts. And these are contracts that are really I think of them as maintenance contracts. So I pay someone to come and fix my boiler every time it breaks down, or my roadside assistance, where every time I break down, someone comes and rescues my car. And you'll see on the slide, there's certain criteria you need to meet to get into the fixed fee service contracts. But if you do qualify, you have a choice. You can choose to apply the new revenue standard, IFRS 15, rather than IFRS 17. So I think that will be quite helpful for non-insurers. And I think the other thing as well is the residual value guarantees that you sometimes see in leases or issued by retailers and dealers. Those equally are not in the scope of IFRS 17. So that's quite interesting. But the banking world, Sandra, tell us a bit about how you think the standard's going to apply to banks.
Yeah, I think the most important thing to note is banks cannot assume this standard doesn't apply to them. If we start with the most obvious category, some banks, particularly bank assurers, have insurance operations within the group. Now, clearly, if you're issuing normal insurance contracts in IFRS 17 will apply just like it does to an insurer. The next category to think about is financial guarantees. And just like today's gap, with financial guarantees you have a choice. So if you previously asserted that those are insurance contracts in the scope of the insurance standard, then that continues under IFRS 17. However, if you previously accounted for them under the financial instrument standard, then you can carry on doing that. I'm afraid that's not the end of the story. Banks will also have to think about some of the other products they issue. So 2 examples. Banks may have loans due from customers that are waived in the event the customer dies, so not repayable on death. Now they have an insurance component within them, and if that insurance risk is significant, they will fall within the scope of IFRS 17. Another example we see in parts of Europe, banks issue what are called equity release mortgages. These are mortgages granted to older customers, and typically the mortgage loan is repaid when the customer dies or moves into long-term care. At that point their house is sold, but the amount repaid is capped at the value of the house. So if that's less than the amount due, then the rest is forgiven. Now those 2 have an insurance component within them, and again you'll need to assess if that insurance risk is significant. That will depend on the terms of the loan, things like the loan to value ratio and the loan was first taken out, the age of the borrower, interest rates, etc. But if the insurance risk is significant, then they too will fall into IFRS 17. One other thing to note about these products, under today's accounting they probably fall into IFRS 4 as well, but under IFRS 4 you have the ability to unbundle them, so to account for the loan element within the financial instrument standard and the insurance element within the insurance standard. Under IFRS 17 the unbundling rules have changed, so it's very unlikely you will be able to unbundle these products. Rather, the whole product will need to be accounted for in IFRS 17, and that will be a big change for many banks.
Thanks, Sandra. One of the other things I wanted to mention was the investment contracts with discretionary participation features, or DPF. I haven't got time to explain what those are today. That'll be the subject of a future video. But if you do issue those would have been under the scope of IFRS 4. Under IFRS 17, they are only in the scope of IFRS 17 if the issuer also issues insurance contracts. So if you don't issue insurance contracts or aren't in an insurance group, you don't have to worry about this standard either. So that's the scope of the standard. We now also need to look at whether we combine or separate insurance contracts before we start looking at how we measure them. The standard talks about if you have 2 contracts that are issued with the same or related counterparty and they're intended to create some overall commercial effect, then these need to be looked at together when you're applying IFRS 17. I think where this may apply is when you think about some of the reinsurance fronting arrangements, and you particularly see those in group structures, so I would encourage anyone who's got those to have a think about that. But then the more interesting thing is when you separate insurance contracts, and Sandra already alluded to that in the banking products. So you can see on the slide we have 3 different areas where you have to separate out elements of the contract before you apply IFRS 17. These are embedded derivatives, distinct goods and services, and distinct investment components. So Sandra, you're a bit of a guru on embedded derivatives.
Thank you, Gail. I think that's the closest I've come to a compliment all day. The first thing to note about embedded derivatives is the principles are the same for insurers as they are for anybody else. So the key principle is that if an embedded derivative is closely related to the host contract, then you don't separate it. Similarly, if the feature you're thinking about would not meet the definition of a derivative, then you don't separate it. And that's nothing changed there. However, there are 2 specific exemptions for insurance contracts that we need to think about. So the first one is where the embedded derivative is so independent with the insurance element that you can't measure it separately without also considering the insurance component. Now, example there would be an insurance contract with a fixed price payable on surrender. The insurance risk is the surrender risk, and they're too interrelated to separate them. The second exemption is where you have an insurance contract where the amount payable is dependent on a price index, and the trigger of that payment is itself an insured event. So an example here would be a contract that pays out on the death of the policyholder, and the amount paid is linked to an index. And again, that's something that would not be separated. But Gail, as you mentioned, it's not only embedded derivatives that need to be separated. So what else do insurers need to think about?
Yes, I think the other one to particularly look at is the distinct investment component. And this, you'll have quite a lot of these, particularly in life insurance contracts that have savings components. The standard tells us when it is or isn't distinct. And one of the key things it says is it's not distinct if the investment component lapses with the insurance component, or indeed if you can't measure one without the other. And that's actually quite helpful for the life insurers because often they are interdependent and therefore will not be distinct and will not be unbundled. However, as you mentioned, for the banks, that is what catches them, and they will not be able to unbundle that death cover on the loan that waives on death, which is why the banks will not be able to unbundle it. So if you don't meet the distinct criteria, you do not unbundle. I think the other thing for insurers to think about as well is, even once you've taken out the embedded derivatives, the goods and services, and the distinct investment component, you often find different insurance risks bundled together. And some people would call these riders. So I've seen examples where you might have a 2-year medical cover combined with a 20-year term death cover, and that's one contract. And so the question I know some people are asking is, can I split that out into 2 different insurance contracts? And actually the standard is silent on that. So I think that's going to be one of the implementation challenges that people will be asking. So today we've covered what contracts are in scope of the standard, when they have to be combined and when they have to be separated. But clearly that is just the start of what is a very complex standard. I do hope you'll join and listen to some of our future videos. The next one, we're going to be covering some of the issues that property and casualty insurers should look at. So thank you for watching.